Thank you again for tuning in. Today we're going to discuss 25 Delta Skew. One of the biggest mistakes traders make is becoming completely obsessed with price. Price goes up, we become euphoric. Price goes down, we become fearful. But markets often communicate through much more than just price itself. Personally, one of the most important indicators I monitor, especially when I'm in the middle of a position and emotions begin to take over, is 25 Delta Skew. Sometimes it can become your compass in the chaos. So what exactly is skew? Skew measures the difference in implied volatility between out-of-the-money puts and out-of-the-money calls. In simple terms, it helps us understand where market participants are paying for protection. Are traders becoming increasingly fearful, or are they becoming increasingly aggressive? Markets don't simply move because of price. Markets move because expectations change. And skew gives us a direct window into those changing expectations. So why do we focus specifically on 25 Delta? First, let's quickly discuss Delta. Delta measures how sensitive an option is to changes in price. A 25 Delta option roughly implies approximately 25% probability of finishing in the money. Professionals often focus on this area of the option chain because it sits in a very important sweet spot. These options are far enough away from current price to capture hedging demand and fear, but close enough to remain highly liquid and meaningful. As a result, 25 Delta often becomes one of the most cleanest windows into market psychology. Now we're going to focus on one of my key components in pulse, and that's skew under a microscope. The skew under a microscope chart allows users to visually observe how skew evolves over time. Instead of simply looking at one static number, we can begin seeing changes in sentiment. Is downside protection becoming increasingly expensive? Is fear entering the market? Are participants becoming more comfortable taking risk? Markets often whisper before they scream, and sometimes skew begins changing long before price fully reflects those concerns. And this is where skew becomes incredibly valuable. Let's say you're long in crude oil. Price begins moving against you. Immediately, emotions begin to take over. Should I hold? Should I reduce? Should I exit? This is where I personally like to look at skew. If price is moving against you, but skew remains relatively stable, that may suggest the options market is not aggressively pricing additional fear. Perhaps this is simply temporary weakness. Perhaps I need to stay calm. However, if price is moving against me and downside skew suddenly begins expanding aggressively, that may be information. Participants may be increasingly paying more for protection. The information environment may be changing. Skew does not make the decision for me, but it provides context. It helps me remain objective when emotions begin to take over. It becomes a compass in the chaos. Again, price tells us what has happened. Skew may help us understand what market participants are becoming concerned about. And sometimes that additional layer can be incredibly valuable. At Pulse, our objective isn't to predict every market move. It's to provide additional context and build frameworks that help traders make better decisions under uncertainty. Trade the tape, trust the truth. Thank you again for tuning in. Pulse is currently available on Google Play at Pulse-Market Clarity and on the web at cme-pulse.com. Have a great day, and I look forward to hearing from you again.